Hey everyone, I'm Dan Stous, lead advisor here at Flagstone with another market update. And today we'll discuss the most recent corporate earnings report from the first quarter and what impacts that might have on the markets. And why is this relevant right now? Well, lots of investors follow corporate earnings announcements fairly regularly, but there's extra attention right now to these numbers because investors are looking for hints as to whether the economy is starting to slow down or continuing to grow at a steady pace. So for the next few minutes, we'll take a look at some of these trends and why for the long-term investor, it's more important to focus on those trends as opposed to the day-to-day market swings. First, it's important to remember that the stock market tends to follow the trajectory of corporate earnings over time, which is a pattern that's clearly shown in this chart. That light blue shaded area illustrates earnings per share, which is a measure of corporate earnings, while the dark line illustrates the level of the S&P 500 index, which is a benchmark of large U.S. company stocks. And while the two are not perfectly correlated, they follow the same general pattern most of the time. Now, I'll take a step back to mention something that's not shown on this graph. Some investors often focus on the economy, but we don't invest in the economy directly. We invest in the stock market, and shares of a stock represent ownership in a company, which, and this is the key part, your shares of a company entitle you to a portion of that company's earnings. Now, it's no wonder that the stock market performance and company earnings are so closely correlated. Now, while we don't invest directly in the economy, how companies perform does depend in part on the underlying economy, including consumer spending, the job market, inflation, and more. Now, let's focus back on the chart. It does highlight how we can think about stock market swings. So during difficult periods when the stock market might decline, a strong economy rather, sometimes helps to support stock prices. After all, if stock prices fall when earnings are still strong, valuations become more and more attractive and more people are likely to buy at those low prices. And that was the case in 2022. When the stock market fell, the economy was still relatively strong, which helped markets recover. That situation is a little different than if the markets fall due to an economic shock or recession like we saw in 2008, 2009. That's why bear markets tend to occur during recessions when it's unclear what the earnings outlook might be. The bottom line here is that corporate earnings are among the most important factors for long-term investors. Next, this chart shows the earnings growth rate for S&P 500 companies since the mid-1980s. And what you can see on the right is that earnings struggled the past few years, but began to accelerate again in the third quarter of 2023. There's been a delayed effect between steady economic growth and corporate profits, but there are signs that companies are beginning to benefit from economic trends. This also matters because many valuation ratios depend on these financial measures. The price to earnings ratio, or PE ratio, for instance, has risen significantly over the past 18 months as the market has rallied. However, with earnings growth now accelerating, the hope is that valuations will begin to look more attractive. Another way to put this is that investors anticipated stronger earnings growth, which led markets to rally ahead of time. Finally, this chart shows that economic growth has been steady over the past several quarters, despite investor concerns. In fact, the number of references to the word recession in corporate earnings calls fell to its lowest level in 2 years. Other sources of data, including the Federal Reserve of Richmond's CFO survey, suggest that corporate executives are increasingly positive on the economy. Now, these figures can change, but they are positive and do suggest that steady economic growth is translating into better corporate profits. And the hope is that this also supports the stock market, just as it has done over history. This is an important reason that investors should focus on these longer-term trends rather than daily stock market movements. I hope you found these insights helpful. If you're a client, we at Flagstone, thank you so much again for your relationship. If you're not, but you're interested, check us out at flagstonefm.com to see what we're all about. And thank you.